Imagine starting with just $1,000 and watching it grow into $1 million through smart choices and time. Compound interest drives this, acting like a snowball that grows bigger as it rolls down a hill. Your initial investment earns returns from the stock market. Those returns then generate more returns on the larger amount, and this cycle builds wealth steadily over years. Historical data shows the S&P 500, which tracks 500 of America's biggest companies like Apple, Microsoft, and Amazon, has delivered average annual returns of about 10% since 1926, including dividends. If you invest $1,000 today in an S&P 500 index fund and let it sit for 30 years with no additional money, compounding at that rate turns it into roughly $17,000. Time plays the biggest role here, so starting early lets the growth multiply far more effectively. To reach $1 million faster, add regular contributions to keep feeding that growth. Start with your $1,000, then invest just $100 a month, roughly the cost of a few takeout meals. At 10% average returns over 30 years, your total hits around $226,000. Double that to $200 monthly, and it climbs to $452,000. Push it to $500 a month, and after 30 years, you surpass $1 million, having put in only about $181,000 yourself, with the rest coming purely from compounding magic. This follows the standard compound interest formula. Final value equals principal times 1 plus the annual rate divided by compounding periods per year, all raised to the power of compounding periods times total years. Free online calculators from sites like investor.gov or NerdWallet let you plug in your own numbers to see it work instantly. Choose low-cost index funds for the best shot at those returns with minimal hassle. The S&P 500 index funds from Vanguard like VOO or Fidelity's matching options charge just 0.03% annually in fees, a fraction of the 1% or more that many mutual funds take, which can eat thousands over decades through their own compounding effect. These funds automatically diversify across hundreds of top companies, outperforming about 90% of actively managed funds over 15 years or longer, according to Morningstar studies. Skip trying to pick individual stocks or time market ups and downs, which even experts struggle with. Just buy the whole market and hold as it grows with the U.S. economy. Free up that monthly cash by spending less than you earn every month. Target saving 20% of your income right off the top by automating transfers to investments. Tools like Acorns round up everyday purchases to invest the change, or use your bank's similar features for seamless small deposits. Trim expenses like daily coffee shop runs by brewing at home, cook simple meals instead of ordering out, and call to negotiate lower bills on cable or phone service. Warren Buffett, with his massive fortune, still lives in the Omaha house he purchased in 1958 for $31,500, proving you free up serious money by avoiding lifestyle inflation and focusing on needs over wants. Apps such as Mint or YNAB help track every expense, making larger savings like $500 monthly feel achievable without sacrifice. Steer clear of common pitfalls that wipe out progress for most people. High-interest credit card debt averaging 20% APR destroys stock market gains, so eliminate it first using the debt snowball approach, paying off smallest balances quickly to build momentum. Market crashes happen regularly, like the 2008 financial crisis or the 2020 pandemic drop, but the S&P 500 always recovers and hits new highs. A $1,000 investment right before 2008 would exceed $6,000 today if never sold. Instead of guessing market timing, use dollar-cost averaging by investing fixed amounts regularly, which buys more shares cheaply during dips and fewer at peaks, smoothing out volatility automatically. Handle taxes and inflation smartly to keep more gains. Open a Roth IRA for tax-free growth and withdrawals in retirement, allowing up to $7,000 annual contributions in 2026 if you're under 50. Max out any 401k employer match for instant doubling on that portion. Long-term inflation averages around 3% yearly, but stocks have outpaced it by about 7% historically, so your real purchasing power still grows strong. That $1,000 plus $500 monthly at a net 7% real return reaches over $500,000 in today's dollars after 30 years. For quicker results, increase contributions as income rises. Adding $1,000 monthly to your starting $1,000 at 10% returns gets you to $1 million in just 23 years. Funnel raises, bonuses, or side income straight into investments without raising your spending. Real stories prove it works. An Ohio teacher began with $2,000 in 1995, added $400 monthly to index funds, and retired at 60 with $1.2 million. No windfalls required. Books like J.L. Collins's The Simple Path to Wealth break it down plainly. Stick to total stock market index funds, cut fees to the bone, and never stop. In 2026, with President Trump's pro-business stance, including potential tax cuts and deregulation, markets may get an extra boost, but base your plan on century-long trends, not short-term politics. Avoid chasing volatile trends like crypto for core wealth building. Proven index strategies win reliably. Real estate works as a later divider once established, but early on, allocate 80 to 90% to stocks, gradually shifting toward bonds near your goal. Risk exists in all investing, but decades of time and broad diversification across thousands of companies via index funds greatly reduce it for those starting young. Build safety first with an emergency fund covering 3 to 6 months of living expenses in a high-yield savings account yielding 4 to 5% now. Then pour everything else into investments. At $1 million, picture the freedom, no debts hanging over you. Spontaneous travel, funding college for grandkids, or early retirement on your terms. Get started today at no-fee brokerages like Vanguard, Fidelity, or Schwab with zero minimums. Select broad funds such as VTI for total U.S. stocks or VTI for the U.S. stocks or VOO for the S&P 500. Set up automatic monthly deposits and review progress just a few times yearly to avoid tinkering. Decades from now, raise a glass to the millionaire you've become. This blueprint relies on over 100 years of verified market data, not guesses. Start small, stay consistent, and let compounding handle the heavy lifting. Your future self already appreciates the decision. Share your first step in the comments below. Thanks for watching.